On the morning of May 1st, 1989, the Soviet Union appeared to be the single most permanent structure on the face of the Earth. To the outside observer, it was a monolith of absolute power. It possessed 40,000 nuclear warheads. It commanded the largest standing army in human history. Its intelligence networks were embedded in half the governments of the globe, and its sphere of influence stretched from the Berlin Wall to the Pacific Ocean. If you had asked a geopolitical analyst in 1989 to predict the end of the Soviet Empire, they would have told you it would take decades of war, attrition, and diplomacy to dismantle it. They would have told you that superpowers do not simply disappear. They would have been wrong. Exactly 900 days later, the state dissolved. It wasn't invaded, it didn't lose a war, it wasn't conquered by a foreign army, it simply reached the end of its arithmetic. Historians call this geopolitical collapse. But in complexity science, this is known as a phase transition. It is based on the Seneca effect, a model of nonlinear dynamics which proves that complex systems do not degrade symmetrically. As the Roman philosopher Seneca observed 2,000 years ago, increases are of sluggish growth, but the way to ruin is rapid. We tend to believe that empires are destroyed by barbarians at the gates or nuclear missiles in the sky. In reality, they are almost always dismantled by internal accounting. They maintain the illusion of infinite power until the exact moment the interest on their promises exceeds their ability to produce revenue. When that line is crossed, the decline does not happen as a slope, it happens as a cliff. And if you overlay the current United States fiscal data onto that same historical timeline, a disturbing pattern emerges. Most people believe the United States is currently in a recession, or perhaps a period of high inflation. This is a category error. We are not looking at a standard economic cycle. We are looking at a mathematical expiration date. The data suggests the American empire enters its own Seneca window, its own phase transition, in the first half of 2026. This is not a political statement. It is a calculation of structural insolvency. And to understand why 2026 is the mathematical limit, we have to peel back the layers of history to see the machine that drives it. The most dangerous sensation in a collapsing empire is the feeling of safety. This is called normalcy bias. We believe that because the United States has been the global hegemon for 80 years, it is immune to the laws of financial gravity. We believe that the dollar is eternal because, in our lifetime, it always has been. But history is a graveyard of powers that believed they were the exception. The pattern of the 900-day collapse has repeated 3 times in the modern era. And, in every single case, the society involved ignored the warnings until the liquidity dried up. Consider the Spanish Empire in the 16th century. Under King Philip II, Spain was the first true global superpower. It controlled territories on every continent. The sun literally never set on the Spanish Empire. More importantly, Spain controlled the money supply. In 1545, Spanish explorers discovered the Cerro Rico mountain in Potosí, the largest silver deposit ever found in human history. For the next century, Spanish galleons transported massive amounts of silver across the Atlantic. Spain had what the United States has today, the reserve currency. The Spanish real was accepted in markets from Shanghai to London. They had infinite money. They had the strongest military. They were untouchable. Yet, in 1596, King Philip II, the richest man in the world, defaulted on his sovereign debt. He didn't just default once. Spain declared bankruptcy in 1557, 1560, 1575, and 1596. 4 times in 40 years. How is it possible to go bankrupt when you own the money printer? The answer is the zombie phase. Philip II fell into the trap of believing that liquidity is the same as solvency. He used his infinite silver to fund infinite wars. Wars in the Netherlands, wars against the Ottomans, wars against England. He borrowed against future silver shipments to pay for today's armies. But the compounding interest on his military expansion grew faster than the physical speed of mining gold. By 1596, the interest payments consumed the entire revenue of the state. Spain remained a country on a map for centuries, but as a global power, it was a zombie, walking but financially deceased. It never set the global price of gold again. Now, fast forward 300 years to the British Empire in 1945. Britain had just won the World War. The Union Jack flew over a quarter of the Earth's surface. The city of London was the financial capital of the world. The pound sterling was the rock upon which global trade was built. Victory parades filled the streets of London. The mood was euphoric. The empire had defeated fascism. But the ledger told a different story. To fight the war, Britain had borrowed massive sums from the United States. Its debt-to-GDP ratio had exploded to 270%. The industrial base was shattered. The British government tried to maintain the illusion of strength. They promised their citizens a welfare state. They promised the world they would maintain their colonies. But the math always wins. In just less than 3 years, roughly 900 days, Britain went from being the master of the globe to a second-rate debtor nation. In 1947, they were forced to grant independence to India, the crown jewel of the empire, simply because they could no longer afford the military cost of occupation. That same year, they attempted to make the pound sterling convertible to gold again. The experiment lasted 6 weeks before the market crushed them, forcing a humiliating devaluation. It took 3 centuries to build the British Empire. It took less than 1,000 days to liquidate its dominance. In both cases, Spain and Britain, the public was the last to know. The parades continued, the speeches continued, the currency still circulated. But in the back rooms of the Treasury, a specific financial signal had already flashed red, exactly 18 months before the end. That same signal has just appeared in Washington, and this time, the numbers are far larger than anything King Philip or Winston Churchill ever had to manage. To see the signal, one must ignore the political theater. You must ignore the stock market highs, the unemployment rate, and the press briefings. You must focus entirely on the ledger. For the first time in American history, the United States government is spending more to pay interest on its debt than it spends on national defense. This is the threshold. This is the event horizon. When a superpower spends more on servicing its past mistakes than securing its future power, it enters a debt spiral. Let's look at the mechanics of this trap, because it is not an accident. It is a mathematical inevitability designed into the system over a century ago. The United States national debt currently exceeds $36 trillion. Most people cannot visualize $1 trillion. To put it in perspective, if you spent $1 every second, it would take you 31,700 years to spend $1 trillion. The US government owes 36 of those. But the debt itself isn't the immediate killer. The killer is the interest. For the last 15 years, interest rates were near zero. This allowed the government to borrow trillions virtually for free. It was an era of free money. But that era ended in 2022 when the Federal Reserve raised rates to fight inflation. Now, that $36 trillion mountain of debt is rolling over at 4% or 5% interest. The annual cost just to service that debt has breached $1.1 trillion per year. This makes interest payments the single largest line item in the federal budget. We now spend more on interest than we do on the entire military. We spend more on interest than on Medicare. We spend more on interest than on education. This creates a liquidity paradox. The US government runs a deficit. It spends more than it collects in taxes. So, where does it get the $1.1 trillion to pay the bondholders? It borrows it. The Treasury must now borrow new money just to pay the interest on the old money. In the private sector, this dynamic is illegal. It is the textbook definition of a Ponzi scheme. In a Ponzi scheme, early investors are paid with the money from new investors. The scheme collapses when the new money runs out. But in the sovereign sector, this is simply called monetary policy. The government doesn't need to find new investors, it has the Federal Reserve. The Federal Reserve can create money out of thin air to buy the debt. But this solution is actually the accelerant. If the Fed prints money to pay the debt, they debase the currency. They dilute the value of every dollar in existence. This is the trap. If they don't print the money, the US government defaults and the global financial system collapses. If they do print the money, they trigger hyperinflation and the dollar collapses. There is no third door. There is no exit strategy. This is why the 900-day pattern is so predictive. Once the interest to defense crossover happens, the government loses control of its own destiny. It becomes a passenger in a vehicle driven by compound interest, and the destination of that vehicle is a mathematical certainty. So why does the mathematics point specifically to 2026? Why not 2030? Why not next week? To determine the timeline, we have to look at the indicators that have correctly predicted every major financial correction of the last century. Financial commentators often compare today to 2008. They look at the housing market or the banks. This is a category error. In 2008, we faced a housing bubble. In 2000, we faced a tech bubble. Today, we are facing an everything bubble. Stocks are trading at valuations seen only in 1929, with the S&P 500 price-to-earnings ratio hovering near 28, double the historical average. Real estate prices have detached from income levels, sitting 50% above their long-term trend, a gap even larger than the one that triggered the 2008 crisis. And the bond market, the supposed safe haven, is suffering its worst drawdown in history because of the inflation risk. But the most reliable timepiece in economic history, the one that sets the clock, is the yield curve. The yield curve measures the difference between short-term and long-term interest rates. In a healthy economy, long-term rates are higher. When the economy is broken, short-term rates go higher. This is called an inversion. This indicator has predicted every recession since 1950 with 0 false positives. It has a 100% track record. The yield curve inverted in July 2022. It remained inverted for over 2 years, the longest signal in history. But the crash never happens while the curve is inverted. The crash happens when the curve normalizes, when it snaps back. The yield curve normalized in September 2024. Historical data shows that the structural shift, the correction, typically arrives 12 to 18 months after the curve uninverts. Do the arithmetic. September 2024 plus 18 months places the window of maximum probability squarely in the first half of 2026. This brings us to the concept of the event horizon. In astrophysics, the event horizon is the point surrounding a black hole where gravity becomes so strong that escape is impossible. You can still survive inside the horizon for a time. You can still breathe. You can still see the light of the universe outside, but your destination is mathematically locked. All paths lead to the singularity. In 2026, the US debt mathematics crossed that line. The government will likely try to fight it. They will manipulate the CPI numbers to hide inflation. They will change the definition of a recession. They may even implement yield curve control, explicitly printing money to cap interest rates, just as Japan did. But these are delaying tactics. They are the financial equivalent of a terminal patient bargaining with the doctor. Whether the currency resets next year or simply degrades into a zombie dollar for another decade is a detail. The outcome, a massive devaluation of American wealth, is inevitable. In 1929, investors could flee to bonds. In 2008, they could flee to cash. But when the sovereign debt itself, the US Treasury bond, is the source of the risk, where does capital hide? When the foundation of the global financial system becomes the bubble, there is no outside to run to. This is why 2026 represents not just a recession, but a structural break, the end of the American exception. The Soviet Union had 900 days from the first crack in the Berlin Wall to the final dissolution of the state. The fiscal data suggests the United States is roughly 600 days into its own transition. This realization can be terrifying. It challenges our sense of permanence. It threatens the plans we have made for our retirements, our careers, and our families. But panic is not a strategy, and history offers a different perspective. The collapse of an empire does not necessarily mean the end of the world. Rome fell, but Italy remains. Britain lost its empire, but London is still a financial capital. What ends is the order. What ends is the privilege of printing paper and having the world accept it as value. One morning in 2026, or shortly after, the bond market will simply refuse to believe the illusion of infinite liquidity. Risk will be repriced to match reality. The dollar will lose its exorbitant privilege. Prices will rise to reflect the true amount of currency in the system. The standard of living based on debt will correct to the standard of living based on production. But it is important to remember the final law of financial history. Wealth is never destroyed in these transitions. It is merely transferred. It moves from the unaware to the prepared. It moves from the holders of paper promises to the holders of hard value, from those who trust the political narrative to those who trust the mathematical reality. The Soviet citizens who held rubles in 1991 lost everything. The ones who held gold or foreign assets or productive land survived and even thrived. The 900-day pattern is a warning, yes, but it is also a map. This channel is dedicated to documenting that transfer. We are not here to predict the apocalypse. We are here to audit the timeline, week by week, fact by fact. We are watching the event horizon. Subscribe so you can watch it with us.